Theories of interest. We will try to discuss today about classical theory as well as the Keynesian liquidity preference theory. So as we all know, the interest rates plays a very crucial role for the economy. So here we know that interests basically for borrowing money, whenever we borrow money from the market to charge that, or whenever we are investing, for that we also expect to receive certain additional amount of the money for our investments. So now we will see what is the source for this interest. The classical economists like Alfred Marshall has talked about it, that is a loanable funds theory. So that means the people who want to lend the money which attracts the rate of interest. So because they forego their present consumption and investing for a future requirement, so hence it has to be honored with that. So in the classical theory we have major three concepts, that is loanable funds, which is available money for investments. That means the people, certain group of people may save some of the portion of their income, so which will be available for the loans or people who borrow the money. Now supply of loanable funds. When they have funds, so we need to look at how, what kind of determinants it drives the saving rate, right? If your interest rates are relatively high, so the savings will be more because they receive additional income. But if your interest rates are relatively low, so you will not receive you may not motivated to save more. Instead, you may spend more on the present consumption. So in that way, we need to look at how much money availability is available in the economy, that is supply of loanable funds. Then the second is the demand for loanable funds. So we need to see that how much supply is available and how much demand is also available. So accordingly these interest rate theories would work. When there is a more demand for money, then your interest rates would be also increases. So one may now wonder that then where is this equilibrium point, because there can be a demand and a supply. So it has to be intersect where the demand supply matches, that is we call as a equilibrium interest rates, right? So the borrower may be willing to offer some rate of interest, then they can borrow it, and the savers, whoever is saved but they are not willing to invest their own funds directly, but instead they want to lend the money to the required people by certain rate of interest. So where these two matches, where then we can see this is the equilibrium rate of interest. The role of interest, if you see in the classical theory, interest rate seen as a price for borrowing money. As we in general also, we know that, right? Whenever we want to borrow money, so the people charge for it, right? Unlike any product you buy, you have to pay for it and use that product. So similarly, the classical economists also said that the borrowing money, which is equal to the price which you are paying, that is in terms of based on the demand. So wherever if you look at the graphs for this the supply curve for the loanable funds, this is upward sloping. We need to remember for the supply curve for the loanable funds, it will be upward sloping. That what is indicates when we say upward sloping, whenever there is a higher rate of interest, which will lead to more savings, which is again we all know, whenever there is a higher rate of interest, that will lead to saving. That is the reason we are saying that supply curve will be upward slope. So when the demand curve, which is loanable funds, downward sloping obviously, because the lower interest rates will be the more borrowing, right? Whenever you have a lesser rate of interest, people will tend to borrow more money. Again, you may ask, why do they borrow more money? Because like we see in the public policy also, whenever government offers say 25 paisa just for interest rate for various priority sector lending, so that they can borrow for their for regular activities and spend it, so that economic activity will continue. So whenever there is interest rates low, the people tend to borrow more money. That is not only for the priority sector, you can look at the real estate or any other market prices also applies in the same way. So this is what the classical theory basically talks about. What are the simple major criticism for this classical theory? If you see, they say they neglect money supply. So what do you mean by this neglect of money supply? The theory does not consider the role of money supply and the central bank policies influencing the interest rates. So it only says that it is based on the people who are saving or the rate at which is moving, demand and supply the factors, but they are not highlighted or emphasized how these interest rates are derived by the government policies as well as the central bank. We all know the monetary policy control is with the central government, fiscal policy with the government, right? The public expenditure. If the government spends a lot of money on infrastructure and welfare schemes, the money supply will increase in the economy. The other side, if RBI also at the interest of the nation and to make more funds available for the various sectors of the economy, they can also reduce your regular bank rates or the repo rates or reverse repo rates, which will also have some impact on the money supply of the economy. So here the classical theory doesn't talk about the role of the governments and the central banks, how it influences how the money supply changes, because in any economy the government and the central banks plays a crucial role in determining the rate of interest. Now in the classical theory also they assume that there is a full employment which is always in a full employment and which is not often a reality. Classical theories assumes that in the economy there is a full employment, as we all know that in any economy, even idealistic or even you take the socialist economy or a capitalist economy or a mixed economy, we don't see that there is a fixed or where we have a full employment is concerned. So now the rigid wages and the prices, it assumes that wages and prices are flexible, which might not be true in the short run. Of course, we all know that wages and all that may be flexible, but in any organization, in any industry, may not be possible in the short run. It can be possible in the long run. So it is trying to say that this classical theory has not taken into the account of a short run impact, because in an economy the required capital, the money supply even in the short run has a significant influence on the growth of the economy, but the classicals are not given any priority in their theory. So now let's understand the classical Keynesian liquidity preference theory of interest. Okay, so this we all know. John Maynard Keynes in his seminal work, that is General Theory of Employment, Interest and Money, which is published in the 1936, he has challenged this classical theory by emphasizing the role of money demand and supply in determining the interest rates. Okay, so let's understand now the Keynesian liquidity preference theory. So in that, first concept is liquidity preference. Here, for the benefit of again all the students, what we mean by liquidity? The liquidity is how quickly we can convert any asset into the cash. Okay, as quickly we can convert, or you hold a cash, so it is highly liquidity, so that you can transact with that money and you can buy as per your need any kind of product. So the liquidity is in that way. So now the Keynes also says that why do people hold money? First of all, right, one has to see, because when we talk about interest rates, what kind of, where the demand coming for money, we need to understand the determinants of a demand for money. So he says that the people to hold their wealth in the form of cash rather than non-liquid assets like bond. So he gives also three motives. He says the people are holding more in cash rather than bonds or any other deposits. He gives you three major motivation. That is a transaction motivation, which we all know. People hold money for a transaction purpose. Again, what do you mean by the transaction? That means for regular day-to-day activities, whenever you want to buy or sell any commodity, so we need certain cash in our hands. So the people whoever earning certain income try to keep money with them, so that we call as a transaction motive. Okay, so one of the significant driving force people hold is a transactive motive, which every one of us also experiences even at household level. For a given a month, we try to keep certain amount of the money in our total income for regular expenditure. The another important motive what he talks about is precautionary motive. What is that precautionary motive? Holding money for unforeseen expenses or emergencies. So the Keynes also says that a precautionary motives. So people certain amount of the money will hold for any kind of an emergencies. That emergencies may include your medical emergency, or you may need to buy certain commodities, or certain your children's education, or certain kind of unforeseen situation. So people try to hold the money in the precautionary purpose also. And another is the speculative purpose. The third important one is the speculative one. What do we mean by speculative? People who look up to the market certainly wanted to get a benefit by taking an advantage of volatility in the prices. For instance, stock prices. Okay, if somebody trading in the market wanted to hold some money and wait to reduce the price, then they invest. So you are holding money for some time expecting that it will come down, then you can buy that particular stock, so that your rate of return would be higher. Or even today, current burning is the gold price highly volatile. We have seen it has reached to 80,000, 10 grams. Now it has trading below 66,000 rupees per 10 grams. So people who want to speculative, because their interest is not investing just to take advantage of that volatility in the prices, buy at a low price, sell at a higher price, so that you make money. So that is applicable. You can go on explaining for every market. So the Keynes talks about people hold money for these three major reasons, and the interest rate can influence on this all three factors. Okay, so that is, again I repeat for the benefit, the major motives: the transactive motivation, and the precautionary motivation, and the speculative motivation. So now the Keynes says that these three factors can be changed by making higher rate of interest. Suppose if interest rates are high, people who are investing in the speculative market may divert certain funds and deposit in the bank, so that you can reduce the speculative trends in the market. Or where you have precautionary purpose, if in a household kept say 5 lakhs rupees as a precautionary fund for any emergency purpose, but if your rate of interest is relatively higher, then the people may, that caution fund also may, either full or partial amount may be deposited in the banks, so that funds also made available for the economic activities. So the Keynes says that we need to understand the major motives of the humans, and accordingly we can change the the rate of interest rates. Either whenever you want the money supply should be reduced in the economy, then we increase the rate of interest. Whenever you want to increase money supply in the economy, we reduce the your interest rates, so that people tend to spend more, and people, not only earning people, the others also may borrow easily and spend more. So hence he says that by changing the interest rates, by understanding these three major factors, we can able to do better. So here another is the demand for money, which we talked about. So Keynes says that demand for money is inversely related to the interest rate, right? As I think we have already discussed in a great extent, whenever the interest rates decreases, people prefer to hold money. So that means the liquidity they want to hold in terms of cash. This is a common trend even today. That is where Keynes is also known as a modern father of economics, because his theories are relevant even in the current context. Because even he has told in people, whenever it doesn't have higher rate of interest, people may not save. Instead, they prefer to hold cash, or they consume goods and services available for them. So hence, opportunity cost of holding money is very lower, right? When I am holding a cash, and because it's low, so people tend to. So that is where he says that we need to understand this demand for money in the context of this interest rates. Again, another concept also in the Keynesian theory, supply of money. We understood now the demand for money. Now supply of money also. This supply of money determined by the central bank monetary policy and is considered as a fixed in the short run. I am sure we might have studied in the macro about the central bank policies. Today even we have monetary policy committee to determine the rate of interest. That is, we call it as a MPC, along with an RBI who is also chairman for this MPC. So the RBI will sit and review quarterly basis that how the rate of interest has to be changed or it should be continued. In general, in the short run, the central bank continue to remain intact the rate of interest, so that the money supply in the economy won't change. But if they are experiencing the higher rate of inflation, then RBI may intervene and do corrective measures by reducing this inflation as well. So in that way, supply of money is also determined. As we said, even banks can give loans. Central bank also, we might have studied about CRR, SLR, certain reserve ratios. Whenever central bank would like to increase money supply in the economy, they can reduce those ratios, CRR, SLR ratios, so that the commercial banks will have more money to lend. And certain times, the central bank also gives loan to the commercial banks. Whenever if they see that there is a good demand for money by various stakeholders in the economy, so commercial banks can borrow money from central bank and lend to various stakeholders. So in that way also we need to understand the role of the money supply by the central bank as well as the monetary policy. Here we are not discussing about the government policies, that is fiscal policy, where the government expenditure. We only focusing on the direct monetary policy which goes on that. So now in this market also we need to have equilibrium rate of interest rates. So as again in this theory also, where the demand and supply intersects, where we can say that this is the equilibrium rate of interest, where borrowers and the suppliers, where they mutually agree at rate which is agreeable, then we see that as a equilibrium price, and that is also the liquidity preference point where we can say, okay, changes in the money supply or shifts in the liquidity preferences also affects the interest rates, which we have already discussed. Now the liquidity preference curve is, how do it looks if I have to interpret? So the liquidity preference curve is a downward sloping, which is reflecting the inverse relationship between interest rates and demand for money. I'm sure by this time you might have clearly understood how and why this inverse relationship exists between the demand for money and interest rates, right? Higher the interest rate, it will be lesser the demand. Hence, one is high, another is low. We say that is a inverse relationship. That is a negative relationship, we can say. In that, money supply curve is a vertical, which indicates that the money supply is fixed by the central bank. I'm sure we all know central bank takes stock of money supply in the economy and prints or keeps money in the circulation as per the total supply of goods and services. So hence, money supply by and large we can say it is a constant again with the central bank as a policy, and wherever they intersect these two will be determined this. Now, so what is the role of interest rates when it comes? In the Keynesian theory, the interest rates is not just a price for borrowing money, but also reflects the public preference for the liquidity. In the classical theory, we said it is said money, it is only price for borrowing. We did not talk about reflects the public preference for the liquidity. So in the Keynesian theory, that liquidity preference, like we have talked about three motivations, that the transactive motive, precautionary motive, speculative motive. So in the your Keynesian theory, we are also taking into the account of liquidity preference theory. So it balances the desire to hold a cash with availability of the money in the economy. Okay. Now, let us try to understand what are the implications of this Keynesian theory for the monetary policy. So, in the monetary policy is concerned, okay, the central bank can influence on the interest rates by changing the money supply. Increasing in the money supply lowers interest rate, with decreases rise them, right. So, here as we already discussed, the which goes in, the interest rates will go on. So, the investments and economic activity. We know the lower interest rates stimulate the investment and economic activity, while higher interest rates can restrain them, right. The lower interest rates always a positive for the higher rate of economic activity. So, which we need to understand. Here, there can be another important concept called the liquidity trap in a Keynesian theory. So, in a situation where interest rates are very low, increasing the money supply may not lead to lower interest rates or increased investments. People prefer to hold cash rather than invest. That we call as a liquidity trap, right. We talked about whenever there is a lower rate of interest, people would more invest, right, and that will lead to more investment. But there can be certain situations like uncertainty in the global economy or the business cycles or certain special given as scenarios. This also may not be hold true. Hence, we say this is a liquidity trap. That means all kind of incentives, whatever we have given, it may not be working. Okay. So, you need to understand this liquidity trap concept also. The liquidity trap is nothing but where the interest rates are reduced, but your savings are not increased or your investments are not increased. That we call as the liquidity trap. Then what are the major criticism for this Keynesian theory is, people says it is only limited for short run, it will not applicable for long term factors, because the interest rates influences by the various long term factors. And again they said, we talked about in Keynesian theory that money supply is fixed. So, they said this assumption also won't hold true. It is not true that money supply can be fixed just by central bank or anything. It is a consistent and there can be many other factors. So, that also has given. And also lastly, they have also mentioned that the speculative motive is overemphasized. Though people may involve in kind of that speculation, but they said that it is not going to hold. So, in a nutshell, if you see the classical theory and Keynesian theory provides that a valuable insights how interest rates are determined, and they have a different perspectives, which says the classical theory basically emphasized the role of savings, investments, while Keynesian theory highlights the importance of money supply and liquidity preference. Understanding these theories will help us in comprehending the dynamics of interest rate, which is a crucial for both economic policy making and financial decision making. So, dear students, we need to keep in mind that these theories, either be it the classical theory, Keynesian theory of demand, which is also where we can see in the real time basis, which is very applicable, because the interest rate factor is the key today, be it your loans for EMIs or taking any house loan. Today, the more we are driven in the consumer economy. So, I think Keynesian theory, I think is still a major application into the current context world. Like, even though there is a criticism that the speculative motives are more driven, but today I think every market, every investment, people are investing by and large on the speculative motive that at a future the rate of return would be better, be it a gold, be it real estate or any other investments. The expectation and the speculation become a significant driving force for the economy. In the another important factor also which we need to remember is that in the classical economist view that the money supply is, or the central bank is, the role they try to say it's very limited, but whereas the Keynesian theory that central bank role is very significant. Okay, so another major difference between even classicals and Keynesian theory also, that classicals believed that the central bank has a very limited role and it has to go with various market forces and other factors, but the central bank plays a minimal role. But whereas in the Keynesian theory, they talk that the central bank plays a very crucial role. And in the classical theory, the view on the money, which is emphasized that the neutral on the medium of exchange. Like as we all know, the cash act as a medium of exchange. They are very minimal. They have very neutral view on that. Whereas in the Keynesian theory, they emphasize that active role influencing the interest rates. And if you look at even the short run, long run, the classical theory is basically focused more on a long run, whereas the Keynesian theory is, the major concern is about the short run focus. And in the assumption of full employment, they have assumed full employment, and a Keynesian theory, it is not necessary that the full employment would exist, but over a period of time the market will be adjusted accordingly.